Welcome back. I am your course administrator, and today we begin Module 11, Part 2, Valuation Techniques. In this session, we will explore the core methodologies used by professionals to determine the intrinsic value of a business. Valuation is a critical skill for any financial analyst or investor, as it forms the bedrock of investment decision-making. We will be moving at a deliberate pace to ensure all technical concepts are fully absorbed. Mastering these techniques requires both theoretical understanding and practical application. Our roadmap includes mastering the discounted cash flow model, calculating the weighted average cost of capital, and understanding various terminal value methods. We will also delve into relative valuation through comparable company analysis and precedent transactions, ending with key decision metrics like net present value and internal rate of return. Each of these components is vital for building a defensible valuation range. We'll proceed systematically through the logic and calculations for each method. Let's start with the cornerstone of intrinsic valuation, the discounted cash flow analysis. The DCF is regarded as the most theoretically sound method of valuation because it focuses on a business's fundamental ability to generate cash over its entire life. Unlike market-based multiples, which can be swayed by temporary market sentiment or investor fluctuations, the DCF looks purely at the cash flow potential of the business operations. We essentially value the asset based on the cash it puts in your pocket. The enterprise value in a DCF is the sum of two main parts: the present value of cash flows over an explicit forecast period, typically 5 to 10 years, and the present value of the terminal value. To calculate this, we need several components: a reliable forecast of free cash flows, a terminal value calculation, and an appropriate discount rate. The discount rate accounts for the time value of money and the risk associated with those future cash flows. We will break down each of these variables in the coming segments. To properly discount those projected cash flows back to the present day, we need to determine the weighted average cost of capital, or WACC. Think of WACC as the minimum rate of return that a company must earn on its existing asset base to satisfy its creditors, owners, and other providers of capital. It is weighted because most companies are funded through a mix of both equity and debt, and each of those sources has a different cost associated with it. Accuracy here is paramount. The formula for WACC balances the cost of equity and the after-tax cost of debt. To find the cost of equity, we use the capital asset pricing model, or CAPM, which factors in the risk-free rate, the stock's beta, and the expected market risk premium. In our example, with a 70% equity and 30% debt split, we arrive at a WACC of 9.3%. This percentage becomes the discount rate we apply to the firm's future cash flows to bring them to today's value. Now that we have our discount rate, let's look at exactly what we are discounting. In a firm-wide DCF, we use free cash flow to the firm, or FCFF. This represents the total cash flow generated by the business that is available to be distributed to all providers of capital, both debt holders and equity holders. It is an unlevered cash flow, calculated before the impact of interest payments. This allows us to value the operations regardless of how they are financed. Let's see how we build this number. To calculate FCFF, we start with EBIT and subtract taxes to get NOPAT, or net operating profit after taxes. We then add back non-cash expenses like depreciation and amortization, because these didn't actually cost the company any cash. Next, we subtract capital expenditures and any increases in net working capital, as these represent cash required to maintain and grow the business. In this example, an EBIT of $50 million eventually leads to a free cash flow to the firm of $30.5 million. It's vital to differentiate FCFF from free cash flow to equity, or FCFE. While FCFF looks at the whole pie available to everyone, FCFE focuses only on the slice left for shareholders after all debt obligations have been met. If you are valuing the entire company, you use FCFF and discount it at the WACC. If you are only interested in valuing the equity directly, you use FCFE and discount it at the cost of equity. Mixing these up is a common error that leads to incorrect valuations. This table summarizes the key differences. FCFF goes to all investors and uses WACC as a discount rate, resulting in the enterprise value. FCFE goes only to equity holders, includes net borrowing in its formula, and uses the cost of equity as the discount rate to find the equity value directly. FCFF is generally better for valuing entire firm operations, while FCFE is more specialized for equity investments. Understanding these two paths is essential for maintaining consistency in your valuation model. In any DCF, we can only project cash flows with reasonable accuracy for a few years, but a business is expected to exist far beyond that period. To capture the value of all those future years, we use what's called the terminal value. This is a massive part of any valuation, often accounting for 60 to 80% of the total calculated value. Because it carries so much weight, the assumptions you make here are incredibly impactful. Small changes in growth or multiples can cause huge swings. There are two primary ways to calculate terminal value. The first is the perpetuity growth method, which assumes the company's cash flows will grow at a constant, stable rate forever, usually tied to inflation. The second is the exit multiple method, which assumes the business is sold at the end of the forecast period for a multiple of a metric like EBITDA. Both methods are widely used, and it's best practice to calculate both to ensure your valuation is grounded in multiple perspectives. Let's walk through a real-world calculation of terminal value using the perpetuity growth method. Seeing the numbers flow through a model is where the real learning happens. We'll take a hypothetical company with stable cash flows and apply our WACC and growth assumptions to see how a large portion of its value is captured in this single step. Pay close attention to how the year 6 cash flow is used as the starting point for the growth projection. The logic here is critical for technical interviews. In our example, year 5 cash flow is $50 million. With a long-term growth rate of 2.5% and our WACC of 9%, we first project the year 6 cash flow to be $51.25 million. Applying the formula, our terminal value reaches a staggering $788.5 million. When we discount that back to the present day using our WACC, it still represents $512.3 million of today's value. This highlights why terminal value assumptions are so heavily scrutinized. While DCF gives us an intrinsic value based on cash flows, we also need to look at what the market is actually paying for similar businesses. This is called comparable company analysis, or comps. It's a relative valuation method that provides a vital sanity check against our DCF findings. If our DCF says a company is worth significantly more than what similar companies are trading for, we need to have a very robust reason why. Comps are market-based and easy for investors to understand. Comps rely on multiples. For early-stage or unprofitable firms, we might use enterprise value to revenue. For most capital-intensive businesses, EV to EBITDA is the most common metric because it ignores differences in capital structure and tax rates. PE ratios remain the gold standard for mature, profitable companies. The key is to select the multiple that best reflects the value drivers of the industry you are analyzing. For example, financial institutions are almost always valued using price-to-book ratios. Performing a comps analysis is a systematic 4-step process. It's not just about picking random companies, it requires careful selection of a peer group that truly reflects your target's risk and growth profile. You have to consider things like industry sector, size, geography, and even the maturity of the business model. Once you have your group, you calculate their trading multiples and then apply those statistics, usually the mean or median, to your target company to see what the market implies it should be worth. Here we see the process in action for a software firm. We select 4 comparable companies and calculate their EV to revenue and EV to EBITDA multiples. By finding the mean and median, 4.2 and 4.1 respectively, we can apply these to our target company's $900 million in revenue and $270 million in EBITDA. This gives us an implied enterprise value range of $3.67 to $3.78 billion. This range provides a market-validated anchor for our findings. Another powerful relative valuation tool is precedent transactions. While comps look at what the stock market says a minority share is worth today, precedent transactions look at what actual companies were willing to pay to acquire a similar business in the past. This is particularly useful in M&A scenarios because it accounts for the control premium, the extra amount a buyer pays to own the whole company. It often results in higher multiples than trading comps, reflecting the strategic value and synergies expected. As this comparison shows, precedent transactions are based on historical M&A prices rather than current stock prices. They include a control premium, typically 20 to 40%, which is not reflected in trading comps. While trading comps show the fair value of a minority stake, precedent transactions reflect the reality of the M&A market. Analysts use both to bracket the value of a firm, with precedents usually setting the high end of the range and trading comps setting the lower or fair market end. Because every valuation relies on future projections that are inherently uncertain, we must perform sensitivity and scenario analysis. It's not enough to give a single number. We need to show how that number changes if our core assumptions are slightly off. What if inflation is higher than we thought? What if our WACC increases by 50 basis points? By testing these variables, we can understand the risks and the potential range of outcomes, making our final valuation much more robust and defensible in a professional setting. Two-way sensitivity tables are perfect for this. Here we see how the enterprise value fluctuates as we vary both the WACC and the perpetual growth rate. We also use scenario analysis to model bear, base, and bull cases. In the base case, we see a value of $1 billion, but in the bull case, with higher growth and lower WACC, that value jumps to $1.35 billion. Providing these ranges allows decision makers to see the full spectrum of possibilities and the factors that drive the most value for the firm. To wrap up our technical content, we use decision metrics like net present value and internal rate of return to evaluate if an investment project or acquisition makes sense. These rules are the final gatekeepers for capital allocation. NPV tells us in absolute dollar terms how much value is created today, while IRR tells us the percentage return we can expect. By comparing these against our required return or WACC, we can make clear, data-driven accept or reject decisions that maximize long-term shareholder value. The rules are straightforward. Accept if NPV is greater than 0, as it creates value. Similarly, accept if the IRR is greater than your required return. While the payback period is useful for assessing liquidity risk, NPV remains the primary decision criterion for maximizing firm value. Always remember to use multiple valuation methods and document your assumptions clearly. Mastering these techniques is not just about the math, it's about the professional judgment used to interpret those results within a strategic context. That concludes our in-depth look at Module 11, Part 2. Thank you for your time and focus today. This has been a lot of technical material, so feel free to review any sections that need more clarity. Please subscribe to SNB Experts, your course administrator platform, for more modules and expert training updates. I look forward to seeing you in our next session as we continue our journey into advanced financial modeling. Goodbye for now, and see you next time.